Hello and welcome to another video. My name is Nikola Petkovic and today I'll be talking to you about mortgage and payment plans, especially post-handover. Now, I'll be answering some questions like what's the difference between mortgage, home loan or payment plan from a developer? How do you know which one is better for you according to your needs and your requirements, and is one of them more affordable than the other? I'll explain the difference between them, and since these are the two ways we can finance properties at the moment, we'll start from the older one, which is mortgage. Mortgage or home loan has been going on for a very long time, and it has certain requirements for you to get approved for a home loan. Now, the process is by you going to the bank and asking for your eligibility. Your eligibility will tell you whether you can take a home loan or will the bank accept to finance your property for you or not. You will also know by what's the limit that you can borrow from the bank, right? So the way that you can do that, by going to your bank, they will ask you for certain documents. One of the basics ones will be your Emirates ID, your passport and your visa as well. After that, they have certain other requirements. For what they will ask you, what's your salary? They will ask you to for a proof that you are actually employed, and they have one of the things they are requiring is your minimum employment should be for 1 year. So wherever you are working, you need to work there for 1 year before the bank will be allowed to give you a loan. From documents that you need, and one of the points for the bank is that you need to be a resident of Dubai in 99% cases. So you need to already have a valid residency visa next to what I have mentioned, which is passport and Emirates ID. They'll also ask you for your basic contact information and so forth. After that, and when you have a minimum employment duration, they will check for your minimum salary, because the bank has a requirement for minimum salary as well. Different banks have different requirements, so I believe from the moment it's about 12,000 dirham to 15,000, which is the minimum. So some banks might ask for a little bit higher salary at about 15,000. Some of the banks, when you go and talk to them, they'll say it's okay, like even 12,000 salary, we can proceed with the home loan for you. Based on these things, they will calculate what's the maximum, so what you are eligible for. Can you borrow, let's say, a maximum of 700,000 dirhams, or you can borrow 1 million or 2 million or 5 million. And they will tell you this in some period of time. Usually they tell you it takes 2-3 working days, but it knows to be longer than that. So expect it and prepare to wait for a week or two as well. Certain things you should know is, for us as experts in UAE, loan to ratio value in the bank, or the maximum amount that we can borrow for a home loan towards a payment towards property, is 80%. So 80% of the selling price of the property. If the property is selling for 1 million, we'll take a round number, so the maximum the bank can provide you is 800,000. The 200,000 or the 20% is the down payment that you need to make. Remember that bank will never make a payment before you do. So the process actually works like this. Once you go to the bank and you know what you're eligible for, they will tell you, okay, this is the amount you can have, now go search for a property. You go and you search for a property. You also ask them in the meantime to prepare a pre-approval for you. What is pre-approval? Pre-approval is basically a guarantee for a limited amount of time, anywhere from 60 to 90 days, that the bank will actually give you this amount once you find the property. The pre-approval, it takes maybe 2-3 weeks to get it approved, even though they will tell you, most of the banks will tell you it takes 2-3 working days. It's usually longer than that. It costs you 1,000 dirhams, but it gives you a peace of mind that once you actually find the property, you're comfortable going for it and paying the down payment, because you know that the bank will actually proceed with the other payment or repayment of your loan. So the pre-approval, it gives you a peace of mind, and it's your way, a bank's way of guaranteeing for you that they will pay the 80% of your property or finance you with a home loan. So once you have the pre-approval and you know what you're eligible for, you will search for a property and you'll be comfortable to pay the amount of down payment, which is again minimum of 20%. In some cases it will be more than 20%. 20% here is the lowest amount that you can pay for a property. All right. Depending on how you're gonna finance it, it might be more as well. And when it comes to mortgage itself, if you're going through mortgage, you need to know that 20% is the minimum, and the bank will always calculate this if you don't have any other outstanding loans. So if you have a car loan or you already have a home loan, you're going for another one, this will not be the case. The bank will not finance you 80% anymore. They will finance you less than that. 80% again is the maximum the bank can finance for a loan at the moment, and this is only in case that you don't have any other loans, most of the cases, or if it's your first property to buy. Once you have gone through that, you chose the property and you pay the down payment for the property. When the property is ready, the bank will arrange a valuation, which is always by a third party. So they will arrange a person to come and evaluate the property. Why they do this is to confirm that your property is actually worth the money that you're paying for, the money that they are gonna pay for you, right? So the valuation person will come and collect the information from the developer, from you, probably from your agent, and they will do a market analysis of the area, the building itself, apartment, and the area that your property is in. Once they have confirmed that, the bank then will proceed with the payment, and depending if you're going through Islamic or commercial bank, there is a difference between holding of a title deed. So if you're going through a commercial bank, the title deed of the property, once it's paid, it will be under your name, but it will be kept by the bank. The original one will be kept by the bank for their protection, and the copy of it will be given to you. And in anything you need, basically, you can finish with that. But if it's an Islamic bank, the property will usually go under their name until you have paid off the full amount of loan, and then it will be transferred under your name. Remember that whenever you're buying a property through mortgage, it needs to be registered as such in Dubai Land Department, where you will have an additional fee of 0.25% plus 200-300 dirhams as well for the processing. But this 0.25%, it will be calculated in your loan in most cases, and the property needs to be registered as such, like mortgage property, in Dubai Land Department when you are transferring it under your name. There is also a fee of 1 to 2%, which bank charges for the processing of the mortgage. This is something to keep in mind as well when it comes to bank expenses, and you probably don't have to worry to pay this at once, because the bank will calculate it inside of your home loan amount, of your mortgage amount. Now, payment plan from a developer is a little bit different, and it's a bit more simple as well. Payment plan from a developer, you don't have to deal with the bank. You are dealing directly with a developer, right? So when you go and you find the property with your agent, they will find the property that you like, the property that you want to go for. You ask them what's the most usual question is, what's the payment plan on this property, right? So when people say payment plan, they usually think of the post-handover payment plan, and I'll explain the difference. Payment plan can be pretty much anything, and it's usually payment distribution. So there is some buildings where you don't have post-handover payment plan, most of them actually, where you will be required to pay 20 or 30% down payment now, and once the building is completion, you pay the rest, which is 80 or 70%. So let's say you're going for 30-70 payment distribution, you are paying 30% now, or while the property is under construction, and the 70% you pay on handover. Now this is a payment distribution, it's not a post-handover payment plan. Post-handover payment plan is something different, right? You can have the same amount of 30/70, let's say, the distribution. 30% will be paid while the property is under construction, 10% now at the booking, 10% when the property reaches 80% construction, and 10% when it reaches 90% construction. But at the time of handover, which is 100% construction, so the property is finished and you can receive the keys or the handover of the apartment you have bought. Now you start to pay post-handover payment plan, which is in this case 70% of the value amount or the price of the apartment. This 70% will be divided into equal monthly installments or quarterly installments, which are going for X amount of years. So let's say in this case we said you have a property that's going 30/70 and you have 5 years or 3 years to pay it off. Then the balance of 70% will be divided into equal monthly installments over those 3 years. I will try to attach one example here as well for a property where you can see how these payments are distributed. Now, the minimum when it comes to payment plan is 20% of a down payment, and it's usually limited by the number of years. The maximum I have seen is 10 years, but remember, whenever you go for a longer payment plan, your price will increase as well, and this is one of the differences also that I will be talking about. Usually there is a larger amount of down payment which is required when you deal with a developer or you want to use a payment plan from a developer. Usually it's 40%, like 40/60 or 50/50 or something like that, depending on the developer and depending on your overall deal. Now I will try to attach, as I said, one example where you can see a different sort of distribution, like 40/60 over 5 years. 40% you pay before the construction is completed. Once the building is completed, you have 5 years to pay the remaining 60%, so you're paying basically 1% per month or 3% per quarter, right? So for your reference, I'll try to attach it into the video. Now, when we have covered that, what are some main differences? Some of the main differences are in duration. So the payment plan usually goes for 2 or 3 years. It doesn't go much longer than that. You can find maybe 5 years or 7 years, or the maximum, as I said, I have seen is 10 years. But remember that there is a premium to pay on that as well, which we are coming to next. For the mortgage or home loan with the bank, you can choose anywhere from 5 to 25 years. The thing to keep in mind here is that if you go for a lower amount of years, let's say 5 years, your monthly installment will be a lot higher, but your overall price will be lower compared to the 25 years. If you go for 25 years of a bank loan, you will have to pay a lot higher overall price for the property, but your monthly installment will be way lower. So it depends what works better for you. Everything can be calculated when we take a single example of a property, and then you can see exactly the price as well. The next thing is the fixed installments when it comes to a payment plan. When you're dealing with a developer and using their payment plan, you have fixed monthly installments. So you know every month exactly how much you need to pay, and it never changes. When you're dealing with the bank, you have interest, which is accumulating, and it also varies because you can never have a fixed interest rate during the whole period of the mortgage. The maximum one is for 5 years, but if you go for that, your interest will be very high for those 5 years. Second thing, as I said, there is a premium on the price if you go with the developer and the payment plan, because the longer they need to wait for you to collect all the money from you, the higher your price of the apartment will be. While on the bank, on the other side, you have accumulating interest, and it comes to the same, pretty much. The lowest amount of down payment in both cases is probably 20%. With developers, it depends again. So sometimes it's 30%, sometimes it's 40%. It depends. If you don't have that kind of money, then you probably will have to go through mortgage. Basic difference is there is no processing fee with developer for the payment plan post handover one. But with the bank, you will have 1 to 2% processing fee as well, with 0.25 mortgage registration fee that I mentioned as well. If you're going with the payment plan as well from a developer, you do not need a residence visa. This is why it's very convenient for investors from outside the country. But if you're going for mortgage, you will be required to have a residence visa as well. And you don't need any employment. If you are going through developer's payment plan, nobody will ask you for that. But if you are going for a mortgage with the bank, you need a minimum of 1 year employment. Between these two, which one is better for you? This is an individual thing. And according to what I have just explained, I think you can have a certain idea of what works better for you. You can always contact me to know more about it. And we can meet as well, set up a meeting where we can discuss further about your case, what you would need, and get you more information on that. Thank you very much for watching the video, and remember to subscribe as I plan to make more of them. You're also most welcome to give me any sort of example, what you would like me to talk about or explain more in the comments as well. Thank you very much.